FXStreet Signals Service, a new launched product. We are repeating this series of webinars twice a week now to introduce you on this newly launched service. The presentation will be, I will try to make it as brief as possible. It will consist of 5 blocks. We will cover all the aspects concerning the service. After each block, we make a short pause. You can drop the questions, and as we move along, you have the chat box where you can drop any questions while I'm presenting the material, and hopefully we engage in a conversation. Okay, so let's start. The first block, on the first block, we'll focus on the trading philosophy, how we approach trading with this service, and one of the main characteristics of the way we trade here is to think big and trade small. And by that, you will see that we make use of very small-sized trades in order to build an overall portfolio or position in the market, which eventually can surf along the larger trends, the larger themes affecting the market. Okay. Now the idea here is, although we are a signal service, although we have quite a not a high frequency of trading in the terms as we know the term, but we have several signals per day being triggered, and the idea is not to over position ourselves in one single trade, but to let trades be just small parts of an overall bigger position or portfolio. Okay, and we do that with a small leverage per trade. We'll come to details of leverage in another block, but this would be one of the characteristics. We do not go in and out of the market with single trades. We are always in the market with several trades. More or less, our average of open trades has been between 15 and 30 open trades at any moment. The trades by itself are very small sized. It is the overall position, which is something we focus on, something we monitor in terms of risk, in terms of orientation, directional bias, and so on. Okay. Another characteristic of the service is the tuition you receive when becoming a member. We are continuously explaining the rationale behind our positioning, behind the trades. And we explain the systems as far as we can. And we also analyze the market beyond the markets that we are actually trading, which is FX. We analyze other asset classes, such as equities these days. We have been focusing a lot on US indices, with our big reversals we have seen. But we also cover commodities, metals, and special. We cover, eventually, we look at the bond market, at the crypto market, and we follow a lot of market indicators, which can provide us an idea of the risk appetite we are seeing in the market. So we can look at copper prices, at VIX. We can look at particular stock sectors in the market, how they are performing against each other. There are some clues to what the market may be doing or what the sentiment may be at any given moment. Okay, and all these we try to explain on an ongoing basis in the chat room. We answer questions, we do exercises, we do a lot of stuff from which you can learn a great deal. So it's not a black box type of system where we just send the signals and you follow them blindly, but we try to explain them, explain how they are built. Each strategy reacts to different patterns, and we also try to contextualize the signals within a bigger technical horizon or a bigger macro picture. Okay, so there is always something new to learn. That's about the trading philosophy, the main characteristics of our system. Then let's look at the system anatomy. The system anatomy consists of multiple strategies. We have multiple robots trading the markets on a full automated basis. The core of the system is based on automation. Most systems are automated strategies which are designed to find a particular pattern, a particular setup in the market, and act accordingly, so they can send signals anytime. They are running 24-hour, and they look at different types of market conditions. Some are trend following, some are mean reversal, some are triggered based on volatility, others are based on spreads, others are based on relative strength. So there are a wide array of technical setups, and the nature of each system is thought to be combined with all the others, so that at any time there is always a system profiting from some market movement, be it based on trending, on divergence, on volatility, and so on. With this combination of multi-strategies, we apply them to a wide array of FX pairs. Okay, we trade not only the majors, but also the most cross pairs. You will see signals triggered in between 40 and 50 different pairs, although some of them are really rare, such as some exotics. You will not see them often being triggered. But we can exploit these inefficiencies in any combination of currency pairs. Okay, and it is proven by our statistics that the pairs offering more opportunity are not necessarily the ones which are usually making headlines. Okay, these pairs like euro dollar, dollar yen, and such, they are very heavily exploited in terms of inefficiencies, so that other pairs, although they have a higher cost, they have perhaps a higher spread or a commission, or they also contain a higher potential to capture these inefficiencies. Okay, that's why they are less liquid and more expensive. If you want something that contains more opportunity, you pay a higher price, and that's expressed in the spread. So we combine a lot of pairs, a lot of strategies, and the resulting mix is that we have hundreds of combinations in terms of strategy and pair. All these combinations are tested in the market, back tested, and only those that have a positive hedge, a win rate, an acceptable win rate, a good payoff, they are switched on and they are used in real trading. Okay, and all these strategies, obviously, they capitalize on different patterns across different time horizons. So you may have strategies running for days and weeks with open trades, which last much longer than others, which are looking at shorter term patterns, and they close the trade, if not within the same day, within the same week. So we have a combination of time horizons. And the overall offer or the offering in terms of combinations makes it very suitable if you have a preference for a different time horizon or time of execution, or a preference for a pair or a preference for a strategy. You can apply only that or those signals to your account. Okay, so you don't have to trade them all. You can inquire about the statistics on a specific strategy, on a specific pair, and based on those statistics, we can provide you. You can organize your trading. Okay. As for the stats, we have a continuous follow-up in terms of track record. We are using MyFXbook to track our trades in real time. Usually, the win rate on the overall portfolio, we are talking here all the pardon, all the strategies and all the pairs together. We are more or less on the 50-51 currently win rate, and we have a payoff ratio which is barely above 1, which we have to enhance. Let me show you here a page of the current stats. We look here at MFXbook, and this is here the this is the evolution of our equity since September on these accounts. We had a demo account which is going back a little bit more into April, I believe, last year. We had a big run up in July, August, with the last risk-off episode, similar to the one we are just seeing now. This last few days, since Monday specifically, we had a huge run-up in our equity in summer, where the equity jumped above the balance line. What you are seeing here is the balance in red, the equity in yellow. We are currently still in a drawdown in the real account since September and recovering, but we are well positioned in terms of what's been developing in the markets in recent days. Here you see you have a win rate of 52%, but the profit factor has been higher, sometimes to 130. Especially if we account since the beginning, since inception of the product with the demo trading, and the drawdowns we have it here have been high in recent days with a spike in drawdown. We are now back to 3 point something, accordingly to my FXbook. Okay, and this is a small account. We try to mimic in terms of sizes a small capitalized account, which many members could have, and this started with 1K, and we are using 1K per trade. We'll come back into the leverage later on, but in any case, you have full transparent statistics in real time through my FXbook. And Okay, let's have a look inside to the system's anatomy, and I will show you the platform we use to automate the trades or to design the trades. This is how it looks like. One of the strategies. This is a flow diagram where all the indicators, you can see that the different indicators, RSI, Bollinger, and all sorts of conditions. Okay, all sorts of conditions lead ultimately to a signal. Okay, there are many strategies we are using, different types of them. Yeah, like I said, each one capitalizing on a different pattern or a different setup. The strategies are sometimes complex. They have several layers of complexity. Some of the elements we are using, they contain inside these elements. There are again a new diagram. So there can be layers and layers of diagrams. Some of the strategies, they make up to 1,000 calculations per period, be it a minute or an hour, depending on the time frame the strategies is used. Okay, this was just a brief look inside in our system development software. Okay, fine. We move on to trading. If there is any question, please drop them in the chat room. If not, I will I will proceed with the presentation. As for trading, the execution, our execution is automatical. The trades are executed directly from our automation software into our account, and the signal is sent immediately to the chat room, to the Telegram group, where you receive the signal. At the same time, the signal is also seen in the signal page by hand of these small chips where you see the pair, well, the strategy name, pair, time of open or close, the price, and eventually also take profits, stop loss, and so on. You can see the strategies which are running and the ones which have been closed. If they close in profit, there will be a win here. Not, it is a loss. And these are just the recent trades being closed. Once they are older than a week, I believe, they fall out of the table, and they can be seen in the My FXbook page, for instance. Okay, so you receive them here, and you also receive them in the chat room. They look like this one. You have a signal, open it, the name of the strategy, the trade ID, the pair, direction. Okay, this is how the system looks like in the Telegram group. Okay, the exits they function the same way. They are automated on our side. They are sent to the signals page immediately, also to the Telegram group, so that you can act accordingly. If you want to mimic our trades, you have to execute them manually on your side. There are certain strategies where we can, in advance, know that they will trigger a signal. Like, for instance, we have one of the strategies is trading economic impact data. We know when the economic impact data will be released, and we can act accordingly. We can be prepared for we can prepare for the signal in advance. Other strategies, we never know when they will trigger the trade. We can more or less expect them, but we react to them after or once the signal is triggered. We can contextualize the signal. We don't use very short time frames, so that there is usually enough time to check the chart, to check the context, and to act accordingly. Especially in systems where the time frames are higher, such as 2 hour, 4, 12 hour. There is usually, or daily data. There is usually enough time to act. In any case, you have also systems trading on 30-minute, which are a little bit faster. If you have the time to follow them, you can follow them exclusively, or you can combine it with others. In any case, we can provide all the information on the time frames, on the trade duration, and so on. And you can also build your portfolio with the strategies which fit mostly to your profile. Okay. I have a question here. How much is the drawdown? We had a historical drawdown of a little bit more than 20%. A floating drawdown. Okay, that is the drawdown we have, and this drawdown is by using a leverage of more or less 15:1 to 30:1. Okay, so if you use higher leverages, and by leverage I'm talking about effective leverage, that is the number of open trades in relation to your capital, to your equity. Okay, so the most gearing we have used is 30:1, which is a position that is 30 times bigger than our account. Okay, and with this kind of with levels of gearing, of effective leverage, we have endured a drawdown of 20%, 25%. Okay. The leverage we use, like I said, is quite low, and especially trade by trade, our leverage is very low. We usually go into a trade, not leverage. We go 1-to-1. We are using the same account size or the position size equal to the account size on a 1-to-1 basis, so that we can work with multiple trades at the same time, and by summing these positions, we get to a leverage of 50:1 on average. Okay. Sorry, I've jumped here one block. I've jumped one block. We will cover the leverage in a moment. Back to the trading, to the execution. The exits, like I said, are done equally as the entries on a manual basis on your side. And besides, on top of this automation, we apply a discretionary layer. By discretionary layer, I mean that we can switch on and off the systems themselves. So if we have a combination of a strategy and a pair, and we, for the reasons we find, be it technical, macro, cyclical, whatever, or from a risk perspective or a money management perspective, we decide not to trade that particular pair or that particular strategy, we can switch the system off. Okay, the strategies are usually separated in the buy and sell side. We have each strategy, sell and buy, as separated strategies, so we can switch them on and off the both legs, and we can also switch on and off strategies for specific pairs. Okay, so that there is a discretionary control on which strategies we currently use. And besides, there is also a discretionary layer once the trade is open. We may tweak the trade in terms of targets, stops. We may even abort a trade once the signal is triggered. The signal is triggered. We don't like the setup, we disregard it, we abort the trade. That may happen, okay? This discretionary layer, as I said, is based on the technical picture, also on macro analysis. We usually follow the most important themes affecting the market at any time. We build our trade ideas, we generate trade ideas for the mid to long term, and we try to build the portfolio accordingly to these trade ideas generated based on macro themes. Okay, so there is a combination of short-term and long-term view in this service, and you may use it or not for your own trading. That is, if you prefer to trade on a more technical side using shorter term trades, you may only follow those strategies which are short-term oriented, not so much based on the macro picture. Okay. Then we have the cycle analysis, which is also conditioning our discretionary decisions upon the automation. Okay, we look for clusters of important cycles, and we are on alert on spikes in volatility, on the trend changes based on this clustering of cycles. We have just had a cycle cluster in mid of January, where we reduced our exposure a lot, and we awaited for the market developments to decide in which direction to go. Then it was clear that we should be risk-off oriented from that point on. It was a coincidence or not. All the virus pandemic appeared at that time precisely to the cycle cluster, and this gives us an extremely valuable tool in terms of timing, because most of the strategies, be them technical or fundamental oriented, the timing factor is something that most indicators in technical analysis don't have, the time dimension. So we enrich our analysis using cycle theory as well. Okay, then let's move on to money management, exposure, leverage, hedging, and position size. This is the last block of our presentation. If there is any question concerning the prior blocks, and you are free to drop the question here in the box. As for money management, the exposure is something we currently inform our members how we are exposed in the market in terms of currencies. We tell at this moment we are long yen, we are short Australian dollar, and so on. So we may have different strategies open in different directions at the same time, but in the end, the net exposure determines how our overall position, how the entire portfolio is in which direction it is pointing, and the exposure informs how we are effectively oriented in the market, and which currencies we are preferring at any moment, or which currencies have been used by our automated systems to capitalize on the current situation. So the exposure is something we inform our members on a continuous basis. The leverage is also something we keep an eye upon every day, and we, as I said, we try not to be over exposed or over leveraged in the market, and we with the example of our real account, We try to encourage users not to over leverage on a single trade and to profit from market fluctuations. Give enough time to the market to go in your direction, and you will see that using leverage is or a higher leverage is a very interesting uh, facility or something that you can really exploit, but you need a particular type of strategy to do that. If you prefer to be higher leverage or using a position sizing technique, which is not exactly like ours, you want something more aggressive, you can ask us what type of position sizing technique to use and which systems to use. Okay. So with this combination of strategies and different time horizons, obviously we need hedging facilities. In order to mimic our trading, you would need a platform which enables hedging that is going in the opposite directions in one same pair. By hedging, many times we get asked if why we hedge, because if you hedge, you are losing on one side and winning on the other, and the result in the end is being neutral, and you just increase costs. And that's true, but our hedging is not 100% hedged. We may have, I don't know, 15 open positions, and maybe a 15% of that or a 20% of those 15 positions is hedged. So in the net exposure is still directional. We may be long. Let's check here, for instance, our current positions. You see, we have in the Australian dollar, we have a buy here. We have a buy here in the Australian dollar. Okay. And we have a sell here in the Australian dollar. We have another sell lower. Okay, we have a sell here. So Australian dollar, specifically, we may be hedged right now in terms of sizes. Okay, okay, we have another buy here. So we may be long, even now, long the Australian dollar. Okay, but we know that these positions will be cutting their trades within, if not hours, a couple days. Okay, so in the end we'll be net short Australian dollar again. So we may be for a brief moments in time totally hedged in a certain currency or a certain pair, but then the hedge dissolves again, either because the time horizons of the different strategies made one liquidate the trade and dissolve the hedge, or we actively, using our discretion, dissolve the hedge. Okay. Right now we are not taking advantage of hedging a lot in our positions. We may from time to time use more hedging, but we never reach the 100% hedging, because that would be just unnecessary cost. Okay. As for the position size, like I said before, we use a 1-to-1 per trade position size. We do not calculate risk per trade in terms of fixed fractional calculations, which is the most well-known technique in the Forex arena. In order to calculate the stop, you measure the stop and divide the number of pips and by the 2% or 3 or 1, whatever you want to risk, and then you have the position size. We do not calculate position size this way. It would be too complicated for so many positions. We rather prefer to use a 1-to-1, fixed size per trade, and we give the same importance in terms of of a risk to all the positions. Where we differ from a fixed fractional position sizing is in the PIP value. We do not consider, and just this is just our approach to risk, we do not consider that a stop loss at 100 pip contains the same risk as a stop loss at 20 pip. A stop loss that is much closer to price has a higher risk because of market structure, because of flows, and the proximity is a determining factor. So by using a fixed fractional, you would be risking the same 1% or 2% in both situations, in a 20 pip stop, in a 100 pip stop. In our view, it's not the same. So we use a much simpler position size technique, and we manage the risk in the overall portfolio. So we may have positions like we had just recent a position going against us. I believe it was the euro out buy trade. This trade closed for 140 pips plus, but it was in negative for over 150 pips during 10 days or so. Yeah, but we are hedged. We had this was a buy trade for the euro. We had a sell trade. We had a sell trade which was closed. So I don't see it here, but it was hedged in any case, so it was not affecting the overall position a lot. So we endured the drawdown, and we closed in the positive afterwards. Okay, so this small position size enables us to endure single trade drawdowns a lot, and do not freak out if something is going wrong. Like last week, we had this fall in the yen, which caused our equity to suffer during a few days. This week we recovered, but it's important to trade small and think big in order not to jump out of a potential position that may lead to profits later on. Okay, I think that's all. These are the 5 blocks we had to cover. If there are any questions, you are welcome to drop them here. And in any case, we will meet again in 2 days on Thursday, same hour, same place. We'll repeat the webinar. If you have questions by then, you can bring them along. We'll repeat more or less the same structure of the webinar. And I hopefully see you in the chat room, in the Telegram group. Okay, thank you very much for attending, for your interest, and see you soon. Bye-bye.